The S&P 500 ended its 3-day win streak. It closed lower by 0.57% today, but that was well off the lows of the session. Of note, Philip Morris International was really a laggard within the markets today, reporting earnings and having one of its worst days in years. So that did carry over to a number of the other consumer staples names. Today's trade application is going to focus on a non-stock situation where we can look at an ETF during earnings season to maybe practice some of our trade opportunities. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's April 19th, 2018. If you're new to this video, we want to welcome you aboard. Thank you for checking us out here tonight. Remember, you can always click the subscribe button on YouTube in order to be alerted whenever these videos are posted on a nightly basis. Some of you will even see a floating icon for Market Scholars, a little pencil in the lower right-hand part of your YouTube screen that if you hover over it, you can subscribe directly from there as well. Keep in mind that if you enjoy these broadcasts, we would encourage you to click the thumbs up icon on YouTube to let us know that you want us to continue to do these videos going forward. In addition to that, you're welcome to leave comments for us by scrolling down below. And then lastly, in the description area, you'll find some handy links. One of them will allow you to sign up for our email distribution list, which will entitle you to finding out which stocks are giving you overbought and oversold cluster signals within the S&P 500 on a daily basis. Now, in addition to YouTube, David and I are both heavy users of Twitter. We'd encourage you to follow us there as well. My handle is @BrandonVanZee, all one word. Market Scholars handle is @market_scholars, and David Settle's handle is @DavidSettle42. While you're on Twitter, if you wouldn't mind clicking the like and the retweet button on the video, on tonight's Market Outlook video, which we typically will pin to the top of our timeline, that would be fantastic. We also make it nice and easy for those of you that watch the video through the Market Scholars website to click like and retweet on Twitter directly from our website now as well. We're also on Facebook, so make sure you're checking out the Facebook group. We've got about 1,000 folks that are hanging out there these days and distributing excellent market commentary in their own right. You can see the web address on the screen in front of you. All right, with that, let's go ahead and get into some of our analysis for the day. You can see that I do have the S&P 500 chart pulled up in front of us here. As mentioned before, we were down 0.57% today. You'll take a look at this candle right here and you'll recognize that we did close well off the lows of the session, and that's why you've got that long wick there at the bottom of the body of that candle. It shows you that the markets were selling off earlier in the session, and by the end of the day they ended up closing up a little bit higher than off of the lows. Now keep in mind, of course, we were still down from the previous day's close. So it kind of depends on your impression of things. Remember that this style of a candle right here, some people would call it a hammer, some people would call it a hanging man. Remember, the distinction between those two things is where in the line of candles does it fall? Is it at a support area or is it at a resistance area? And even that can be debated. Remember, that's the beauty of technical analysis. It's in the eye of the beholder. So some of you might say, well, Brandon, this looks like it's at a support level because it's right there at that moving average, which you can see is colored yellow right now. Reason for that, moving average itself is traveling lower. Price is above that moving average. Now, I did get a comment about this on Twitter. Somebody said they were confused by that point. I want to be crystal clear about this. When we talk about the posture of the market forecast indicator, it can be different than the direction of the moving average. I think most of you are aware of that, but it probably would benefit us if we would repeat that regularly throughout these sessions as well, so I'll try to remember that in the future. But one more time, the direction of the moving average itself does not determine the posture of the market forecast indicator. They are two separate and distinct things. Now, more times than not, you will find that they confirm one another, but there are going to be times like right now where we have that moving average that's just drifting a little bit lower where price is above that. You'll notice that the intermediate green line on the market forecast down here is pointing up. Remember, again, that has nothing to do with this moving average on the chart itself. So posture using the market forecast indicator is bullish right now. The moving average of prices over the last 30 days is drifting a little bit lower. So that's why you see the tip of that moving average as yellow. If that moving average line were pointing up along with the posture being bullish, then that tip of that moving average would be green. So back to the conversation I was having before regarding the shape of this candle being either a hanging man or a hammer. So some of you might say, well, it looks like it's at support because it's at that moving average right there where it looks like it might bounce off. So some of you might view that as a hammer at a support level. Other people might say, well, we've just had a really nice bounce off of the bottom over the last month or so in the price action, and now we're starting to form a rounded top. Some of you will look at that as being near the top or the resistance area of the recent candle trend. So in the end, it's up to you to determine what your belief system suggests. But right now, I can factually say that the posture of the market forecast indicator is bullish at this current time. In fact, it's strongly bullish, and that's why this green that you see off to the right here is a slightly deeper shade of green than this shade of green just to the left of it. What that signifies is that not only is this green line going up, which again determines whether something is a bullish posture or a bearish posture, but it crossed through the 50 level of that market forecast indicator. Remember, market forecast has an upper reversal zone at 80, a lower reversal zone at 20. 50 would be directly in the middle of that. So the way that we view this green line going up and through 50 is actually a strongly bullish posture as opposed to just a weakly bullish posture. So that's a little bit of the nuance of some of these new charts that again will be made available to those of you that are paying subscribers of Market Scholars here within the next week or so. Let's go ahead and take a look at our next chart setup, which will be our 4 grid, to take a peek at what's going on with the other indices in the United States besides the S&P 500. And so the good news is we've got bullish postures across the board, whether you're talking about the Dow Jones, NASDAQ Composite, or the Russell 2000. So despite downward price action today, remember, one day does not make a trend. We continue to have bullish postures across the board. So will this end up leading to some short-term skittishness? That's entirely possible. You'll notice, as just one example, if we look at the Russell 2000, remember, anytime you want to zoom in on one of these charts, you can just right-click, go to Maximize Sell. You'll notice that from a swing trading perspective, remember, you can set your posture using this blue line if you're a swing trader. We default to the intermediate term line because we assume that most people are more of the trend trading variety. But if you yourself are a swing trader, you might be setting your posture using the market forecast indicator with this blue line right here. Notice this blue line did come down and form a lower low. Notice right over here, we had a low on the blue line at around 66, and as it stands right now, we're at about 56. In fact, you can read that most recent reading, remember, in the labels of the market forecast plot that I have here as well. So the near-term line right now is at 56 and falling, but its low point over here was at 66. Well, if you kind of match that up with the candles up above, notice that we had a candle right here on that first plot when it was at 66, and this one is where it's at when it's at 56. So we have two different things going on. We have a lower low taking place in the near-term line. At the same time, price is giving us higher levels. And so there's a little bit of a divergence taking place right there. And again, it wouldn't be entirely surprising to give back some of these gains that we've had here recently. It has been a really nice move off the bottom over the last month in all 4 of our market indices. As far as today's leaders and laggards, the leader was the Dow Jones. It was only down 0.3%. The worst performing index here today was the NASDAQ, down 0.78%. We had talked about in my class earlier today, my dividend growth investing class, about how some of the semiconductor names were really struggling here today, and I'm sure that was pressuring the NASDAQ, which is a tech-heavy index. Let's go ahead and take a look at our next charting setup. In this case, we're going to take a peek here at our 3 green arrows setup. Remember, that's going to be slightly different than how we're establishing our posture using the market forecast indicator. The 3 green arrows are just a fun way to talk about 3 different technical indicators. We're talking about a 30-day moving average on these charts. We're talking about a MACD histogram, and we're talking about a stochastics. And typically, trend traders are hoping to see all of those showing bullishness at the same time. Right now, we're not really in a trending environment, so it's not as helpful as it would have been late last year. typically this style of investing where we're looking at something like a 3 green arrow system, we want higher highs and higher lows. That is not what you see on the charts in front of you. You see basically sideways looking charts. So you discount the fact to a degree that you are getting 3 green arrows right now. Yes, it's true you're getting them. The question is it valuable information to take action off of? And right now, probably the answer of that is not necessarily. It very well could kick into gear here later on this year, but right now, because we're in that sideways channel, it's a little bit less valuable information. So yes, 3 green arrows across the board, but that doesn't change the fact that we're still mostly sideways here in the last 3 months across all 4 of these markets. All right, let's go ahead and take a look at a longer term view now. This is going to be our 1040 crossover method that we've got set up right here. And these particular charts are going to be 3 years in length. All the other charts we've looked at so far have been 3 months in length. So each one of these is 3 years in length. Every one of these candles is 1 week in length as opposed to 1 day. So when we're looking at a 1040 crossover method using a weekly candle chart like we are right here, it's approximately the same thing as a 50 and 200 day moving average for those of you that use daily candles. This just allows us to go back in time a lot further to see what has happened in the past from a longer term view. So what we're looking for in order to receive signals here are crossovers of the moving averages themselves. You can see not a lot has changed here. We've had some fairly decent bounces in the last couple of weeks, and that's kind of bailed out the possibility of a cross. Now, we're not out of the woods yet. You can see that the gold line remains quite close to that black line in most of these cases, but you can also see that it's stabilized. That gold line, let's just use the Dow Jones as one example. So again, I'm going to right click, go to maximize sell. You'll notice that that gold line was really coming down at a rapid rate here, but now you can see that gold line is just going sideways. So that's where I was saying it's kind of bailing itself out, because if it would have kept up at that rate of going down like we saw a couple weeks back, then yeah, then all of a sudden you're starting to get fearful that we're going to get a crossover of those moving averages, which in this case would have been a bearish sign if that were to occur. But right now we are starting to go sideways on that gold line. And remember, that gold line is going to be more sensitive than the black line on this chart here because it tracks a fewer amount of candles, 10 versus 40. So if markets can stay resilient, then that moving average should not be crossing to the downside. And that's what we're seeing right now. So let's now take a peek at our sectors 12 grid. And this is where I've got to kill that camera feed so that way you guys can see every square inch of my screen here. But as a reminder of what we're looking at, these are all 3-month daily candle charts. The chart in the upper left is the S&P 500. All the 11 charts that follow it are the various sectors that make up the S&P 500. So as you can see, for the most part, it is a bullish environment out there from a posture setting perspective. When we have those green background charts here, it means that using an intermediate term line on the market forecast, we have bullish postures. So we have mostly bullish environment across most of the sectors right now. The 3 exceptions to that are going to be the financials, the consumer staples, and real estate. And so I mentioned in the intro that Philip Morris got smoked today. How's that for a good pun? And so Philip Morris, of course, bled into a lot of the rest of those consumer staple stocks. And you can say a really ugly day there for the staples. Staples were down 2.89% here today. You can see that that didn't do any favors for its chart. That was attempting to try to do some reversion to the mean here, had a bunch of those bullish clusters. So let me right click here, go to maximize sell. You can see we had a bunch of these bullish clusters on the market forecast, meaning we had all those colored lines, the green, the blue, and the red in the lower reversal zone. Remember, we don't use the market sentiment for that. You can see the market sentiment trailing on my indicator right here with this dotted orange plot. But we don't use that for the cluster signals. We use the other 3 lines for that. So when we have the green, the blue, and the red in the lower reversal zone on the same day, that's known as a bullish cluster signal, or in other words, an oversold signal. And so that's why you see those green plots right there. Well, oftentimes when you get those, you get a reversion to the mean because it means that something has been sold off too much. We did get that reversion to the mean. Consumer staples eventually stopped going lower and then did reverse back higher. Problem is, now after today's move, take a look at that candle. That was one of the worst candles on the board. We went from being above the moving average to back below it. And now the path of least resistance appears to be back to the downside for the staples. So we'll see what takes place with that going forward. Now, along with that conversation, I want to show you something else that I've been working on. Many of you know I've been working on a lot of different ThinkScripting chart setups here that, again, is going to be made available to those of you that are paying subscribers to Market Scholars here within the next week or so. But one of the things that we've been trying to figure out is how to do some of these comparison charts in a way that makes sense with candlestick analysis. And so you can see that I do have another 12 grid that maybe we'll review fairly regularly here during the Market Outlook videos as well, where we can do ratio charts. A ratio chart is a way to compare one security to another to determine which one has the greater relative strength. So you can see I've got all different types of things going on here with the VIX versus the 3-month VIX, and stocks versus bonds, stocks versus gold, stocks versus commodities, U.S. stocks versus global stocks, emerging market stocks versus developed foreign market stocks. Here we've got discretionary versus staples, and this is what is the reason I came over here. This is what jogged my memory. If you look at this chart, so if I wanted to kind of zoom in on this one, let me just double click, and you can kind of see that if we're comparing the consumer discretionary stocks to the consumer staples, it kind of gives you an idea, an impression of what's going on in the markets. And the idea being that consumer discretionary are the things that society wants but doesn't necessarily need, and consumer staples are the things that consumers need but don't necessarily want. So usually what you find is that it can be a decent indicator of what type of a market we're in, whether we're in a risk-on market or a risk-off market. Well, notice what happened today. This candle went way up and to the right, almost off of the chart right there. And the way that you would interpret this is the first symbol of the ratio chart, in this case XLY, is the direction of whether it is stronger or weaker than the second symbol, in this case XLP. So what this chart is telling us is that after the staples had a couple of weeks of taking some strength from the discretionary stocks, and that's why this chart was going down during that time, we've now seen a complete reversal where consumer discretionary stocks are once again the apple of the market's eye, at least in comparison to the staples. So anyway, get used to a little bit of that ratio chart analysis. Other ones that I have on here are small caps versus mega caps. Down here we've got oil versus gold. Here we've got commodities versus bonds. Here we've got growth versus value stocks. And then here we've got market cap weighted versus equal weighted index. So a lot of different things for us to sink our teeth into as we go forward with some of our analysis on these videos going forward. But let me get back to my traditional charts here again. And we're going to go to our next set of 12 grids now, which will be our foreign markets 12 grids. And here you can see we've got mostly a bullish picture across the board. Again, the background colors of the charts are telling us that according to the intermediate term line on the market forecast, those would be considered to have bullish postures. So all of them except India and China, up here in the upper right of our 12 grid, have bullish postures. Those are the only two that have bearish postures at the current time. So as you can see, China in particular, now this is FXI, which is going to be some of the mega cap names that also trade in Hong Kong, so be aware of that. This is not necessarily the domestic only Chinese market, but you can see here that we've got not only a bearish posture, that's why that background color is pink, but we also have a red line on that moving average, which is telling us that we have price below a falling moving average. And of course that price is just nicking its head on the underside of that moving average, suggesting that it's possibly being used as resistance right now. So maybe some bearish opportunities there in the Chinese market. One thing that did just catch my eye, and I hadn't noticed it earlier today, but wow, look at Mexico. Mexico was down 2.9% today. Not sure what was going on there. I'm sure that there was a story of some sort. I did see that Cuba is passing the reins on to a non-Castro as far as a leader of their government for the very first time here today. But I didn't necessarily see what was going on down in Mexico. But obviously something's going on because that is an outsized day there that you typically don't find. 2.9% to the downside. And it's a bit of a shame because this was actually a chart that was shaping up pretty nicely prior to today. It still has a bullish posture. That's why that chart background is green. But obviously you're going to want to kind of rectify what's going on with the news and determine whether it's worth taking a bullish trade there or not. Let's go ahead and take a look at our final 12 grid here before we get to our trade idea. This will be our intermarket analysis 12 grid here. And you can see here it's more of a mixed bag where we've got more bullish and bearish posture mix where we've got green and red charts here. As far as looking for various trends, one thing that does catch my eye is that we have a stable chart here with gold down below. Notice that gold was down 0.35% here today, but that chart has really just been tracking sideways with a slight upward bias there near the end. But for the most part, we're stuck in a sideways channel with gold. Crude oil has been much more bullish from a commodities perspective. That's your chart down and to the right. Crude oil has really been taking off here recently. It was down today, so pay attention to that candle there and see what takes place there. Remember, that is not necessarily the most bullish of candles that you have right there when you've got that long wick on the upside of that candle at a resistance area. So we'll keep our eye on crude oil there. But our conversation here today for the trade application is actually going to be around gold. So that's why I wanted to focus on that chart right down there, which again has been going largely sideways for the last 3 months. So let me do this. I'm going to go ahead and pop up another chart here. And let me see, what chart do I want to use for this? Let's just do our options trading chart here. And I'm going to pull up GLD as the ticker symbol here. So again, notice that this happens to be a 6-month chart here, but for the last 3 months, which is the first, or this half, if I were to zoom in just like so, we've been largely going sideways for gold. And so I thought what we would do today is practice an iron condor on GLD. And that is actually a trade I think that we did here not too long ago either, a couple months ago, that worked out fairly well for us. So let's see if we can push our luck a little bit further with this type of a trade setup. So iron condor, for those of you that aren't as familiar with it, it's basically a strategy that allows you to make money on two sides of the chart, on both the upside and the downside. What you're hoping for as somebody who's selling an iron condor is that it stays mostly in the middle throughout the life of your trade. Now you'll notice that the current IV percentile rank for GLD is 57, meaning that it's in the 57th percentile over the last 52 weeks. So in other words, we are at a slightly above average level, above 50, where we would be getting juicier premiums now than if the current IV percentile rank were, let's say, 40. So that's maybe another reason why this could be somewhat interesting. You'll also notice from an implied volatility perspective down below here that this trend of the implied volatility is starting to kind of try to come down a little bit. So we're going to take a look at that and see if maybe that can continue going forward. Remember, if we sell a premium that's expensive and that implied volatility goes down going forward, that can actually benefit our iron condor even more. So in order to set up a trade like that, what we're going to want to do is come on over here to the trade tab, pull up GLD on the trade tab of paper money. Then we start looking for the strikes that we want to select for this particular trade. Now, typically, I start my selection process with a 20 delta on both sides. So over here on the put side of the equation, which is going to be on the right-hand side, we've got a delta that's close to 20 here. It's a 22 delta, and that's your 125 strike. So keep that in the back of your mind. Of course, GLD is going to be one of the most liquid ETFs on planet Earth, and so even after hours here, you can see the liquidity is strong enough to only create a 3-cent differential between the bid and the ask. We have over 8,200 contracts in open interest at that particular strike. So we're going to sell the 125 put, and we're going to buy the 123 as our protection on that side of the trade, and we're going to spend we're going to have a very tight bid-ask spread there as well. Look at it's 18 cents by 19 cents right now in the after hours. On the other side of the equation, Over here on the call side, we're going to again look for a 20 delta. In this case, we've got a 21 delta right there. That's going to point us to the 132 call. And then again, to kind of keep the same mantra of doing a $2 wide spread, we're going to look at buying the 134 call here. Again, notice how tight those bid and ask spreads are there. Only 2 cents in this particular case. Again, look at that open interest in the thousands of contracts there. Lots of people trade GLD. So in order to place that trade, or to at least fire it up, you can focus on either one of the sold strikes that you're going to do, whether it's the put or the call side, doesn't really matter. I'm going to come over here to the put side, and I'm going to right click on the 125 strike. I'm going to go to sell, Iron Condor, there it is, and that will load up our trade down below. Now you will have to make some adjustments manually down below to get the trade set up the way that you want, but since we loaded it up on the put side, let's kind of finish that one off. So down below here on the third pink line, it says -1, and that's your 125 put. That's our sold strike. Our bought strike will be right below it where it says +1, but in this case, we're going to change it to a $2 wide, so we're going to go to 123. So think of that as your bull put side of the equation. We're selling the 125, we're buying the 123. In other words, we want GLD to stay above 125. On the call side of the equation, we do need to adjust these quite a bit actually. On the top line where it says -1, it by default loads up a 126 call. We actually want to change that to 132. There it is, 132. And then on the second line on the bought call side, we're going to change that to 134. Again, sticking with that $2 wide thought process right there. So notice that when we adjust our contracts, we now have a credit of 53 cents that we could attain by doing this Iron Condor. Excuse me, at least if we get filled at that level first thing tomorrow morning, which remains to be seen. But we can start figuring out what to expect from a return on risk perspective. So let me click confirm and send. And here you can see where our max profit is going to be. And so that's going to be $53 if we were just doing one contract. And then max loss is going to be $147, again, if we were just doing one contract. So if we wanted to figure out our return on risk, it's as easy as taking our calculator, getting $53 in that calculator and dividing it by 147. Again, that's the two numbers you see off to the right here in the order confirmation dialog box. And that tells you that this Iron Condor has a return on risk of 36%. Anything above 30% has my interest, so I'm willing to continue with this possibility of placing this trade. Now you'll also notice on this order confirmation dialog box, there's break-even prices here to make it easier for you. You can calculate those yourself if you want, but you might as well let the technology do it for you when you can. And so notice that the break-evens on this trade, there's two different break-evens, because remember, you're technically selling two different credit spreads here. And what you're hoping to accomplish is for the stock to stay in the middle of them. But our break-even on the bottom side would be 124.47. On the top side, it would be 132.53. So if we wanted to kind of eyeball how that looks on the chart, we could just draw on there. You can do this from the Analyze tab as well, but there's a couple different ways to go about this process. But let me just use a price level, and I'm going to draw that real close to 132.53. So 132, somewhere right in there. So I'm going to lock that in, and then once it's locked in, I can right click on it, go to Edit Properties, and then I actually can change this to the penny to 132.53, which again was our break even. All right, so that's our top half of our break even. Now let's talk about the bottom level. So I'm going to again draw any sort of random line down there, right click, Edit Properties, and then I'm going to fill that in at 124.47 in this case, which was our break even on the bottom side. So between those two horizontal dotted purple lines on my chart is where we want this security to be on expiration day in May, which is right here where we have this vertical red dotted line right here. So as long as you believe that that is a strong possibility, then this may be a trade that's worthwhile for you. You can see that it does match up nicely with where a 1 standard deviation move would be, and that's what that probability cone in blue is telling us right up there. So on the top side, we're good to go with that thought process. On the bottom side, we're not quite there. So be aware that you might have a little bit more risk there on the bottom side. But the nice thing about that bottom break-even line is you can see it does cross through a triple bottoming area. There's your first part of that triple bottom there in the first week of February. There's the second of the triple bottom there the first week of March. And there's the third of the triple bottom there in the third week of March. So that will maybe help give you a little bit more confidence with this trade as well if you believe there's a big buyer of gold in those particular areas. So with that, let me go ahead and then place this trade. So I'm going to come back over here and get this loaded up one more time. So sell Iron Condor, and let me see. It was actually, we're doing the 125. Sorry about that. Actually, hang on. I was doing the other side. 125, 123 on the put side. On the call side, which are the top two, that was going to be 132 on our sold strike and 134 on our bought strike right there. So again, we're going to get 53 cents out of this, and we'll bump this up maybe to a few more contracts here. Let's do 5 contracts on this. So confirm and send. Everything looks great. Go ahead and fire that off, and we'll see what we can come up with tomorrow morning. So with that, I want to thank you for checking out tonight's video. It's always a pleasure to go to work for you here on these Market Outlook videos. Remember, David will be with you tomorrow. Of course, we've got a lot of analysis along the way over at marketscholars.com as well. If you'd be so kind to go over to Twitter and click like and retweet along with doing that on Facebook and YouTube, that would be hugely helpful for us as well. With that, have yourself a great rest of the night. Best of luck to your trades and your investments. Goodbye for now.